Back in 2020, when Chinese electric vehicle companies like Nio, Xpeng, Li Auto were massively in hype, many investors and fans were hoping that soon the Chinese electric car companies will take over the European and global markets. However, we are now in 2023, and if we just look at the recent car registration data of new electric cars in Europe, Chinese companies are still almost nowhere to be seen amongst the major leaders of this segment of the market. For example, if we just look at the data of new vehicle registrations for Germany in the month of February, we see Tesla still overwhelmingly controls the market in Germany with their Model Y and Model 3 vehicles. We can see Tesla had more than 2,000 new cars registered just in Model Y alone. Also Volkswagen, Hyundai managed to sell 1,000 plus cars in just some of their individual models. However, a major Chinese EV company Nio only managed to see 13 cars registered in February, and 122 cars registered in March. This possibly points very simply to the fact that Chinese electric cars have failed on the international market. Investors underestimated how competitive the market would get in this segment, and how just so many existing car companies would enter the market with their compelling electric cars. To further analyze the challenges at hand here for Chinese EV companies, we also asked ChatGPT why it thinks it might be problematic for new Chinese electric vehicle companies to succeed at international markets, and this is what we got back in response. There are several reasons why it may be challenging for Chinese electric vehicle, EV, companies to succeed in international markets, particularly in Europe and the USA. Lack of brand recognition. Chinese EV brands are relatively new to the global market and do not have the same level of recognition and reputation as established global brands such as Tesla, BMW, and Nissan. It takes time to build a strong brand and customer trust, and Chinese EV companies may struggle to gain traction in competitive markets. Quality concerns. Chinese products have long been associated with quality issues and reliability concerns, which could impact consumer confidence in Chinese EVs. In the automotive industry, safety and reliability are critical factors that consumers prioritize when purchasing vehicles. Chinese EV companies will need to prove their vehicles' quality and safety to win over customers in international markets. Government subsidies. The Chinese government has heavily subsidized the EV industry in the country, which has enabled Chinese EV companies to offer their vehicles at lower prices than their competitors. However, these subsidies are not available in international markets, making it challenging for Chinese EVs to compete on price without sacrificing margins. Cultural differences. Consumers in different markets have different preferences and tastes when it comes to vehicles, and Chinese EV companies may struggle to tailor their products to meet the demands of international customers. Additionally, differences in business culture and practices could pose a challenge for Chinese companies trying to enter new markets. Regulatory barriers. In some markets, such as the USA and Europe, there are strict regulations and standards that must be met for vehicles to be sold. Chinese EV companies may need to invest significant resources to meet these standards, adding to the cost of doing business in these markets. Overall, while Chinese EV companies have made significant progress in the domestic market, expanding internationally will require significant investment and efforts to overcome cultural, regulatory, and quality barriers. Thanks for tuning into this first video, in a new series of videos where we look to analyze the progress of Chinese electric vehicle producers in the international markets. And if you are new to this channel, please don't forget to subscribe to our channel.